Welcome to the Explainer. If you've been watching the markets lately, you might have noticed this eerie calm settling over everything. On the surface, August 2026 feels quiet, almost sleepy, right? But make no mistake, right underneath that thin layer of tranquility, there are absolutely massive, conflicting forces churning. Today, we're going to unpack exactly what's holding everything together and, frankly, what threatens to tear it all apart.
Okay, let's dive into this, because this quote perfectly captures the current dynamic. The dog days of summer are here, characterized by thin volume, narrow index moves, while treasury yields keep tightening the vice. That word right there, vice, is exactly what we need to focus on. We're basically witnessing this epic tug-of-war between the calm surfaces of daily trading and the brutal, systematic pressures building up in the background.
To make sense of all this, here is our roadmap. We're going to cover the macro waiting game, hidden risks and tripwires, AI's broadening innovation engine, market distortions and hedges, the wall of capital, and finally, a bull versus bear synthesis.
All right, Section 1, the macro waiting game.
Right now, virtually everyone in the financial world is just holding their breath. The volatility index, the VIX, which is basically the market's fear gauge, is sitting at a remarkably tranquil level of 15. The whole system looks perfectly stable. But why? Well, it's because the market is just parked, waiting on the July core CPI data. The expectation is that core CPI, which excludes food and energy, will drop to 2.5%. And if it hits that number, it's going to be the first time we've seen it at that level since way back in March 2021. If inflation behaves, the Federal Reserve might ease up that vice we just talked about. But if it misses, well, let's just say that calm VIX won't be staying at 15 for long.
Moving on to Section 2, hidden risks and tripwires.
Just beneath this calm surface, we've got some massive hidden risks lurking in the dark. The absolute biggest tripwire on the global stage right now, a massive central bank collision. On one side, you've got the United States Federal Reserve, anticipating moderating inflation and potentially holding or cutting rates. On the flip side, you have the Bank of Japan, dealing with a rapidly depreciating yen and actively preparing to hike rates. This divergence in policy direction isn't just some boring academic economics problem. It actually sets up one of the most significant systemic risks in the modern financial architecture. So, the crucial point is how this policy collision impacts the legendary carry trade. Here's how the mechanics work. For years, investors have borrowed yen very cheaply because of Japan's low rates, converted it into US dollars, and bought high-yielding US tech stocks and treasuries. Honestly, it's practically been a money-printing machine. But if the US cuts rates while Japan hikes them, that yield gap narrows rapidly. The historical precedent here is pretty terrifying. Under very similar conditions back in August 2024, an abrupt carry trade unwind triggered a violent 6.1% drop in the S&P 500 over just 3 days. That risk is absolutely back on the table.
And monetary policy isn't the only pressure point. We have compounding pressures happening simultaneously in the physical world. Escalating geopolitical hostilities have effectively closed the Strait of Hormuz. That's a vital global choke point, and it's pushing oil prices up to $90 a barrel, threatening to reignite the exact inflation the Fed is trying so hard to fight. At the very same time, the U.S. is experiencing the steepest drop in labor force participation outside of the 2020 COVID shutdown, a 0.7 percentage point drop since January, mostly driven by older workers retiring early on the back of high stock and home values. So we are facing an inflationary oil shock and a structural labor shortage at the exact same time.
To make matters even worse regarding that oil shock, our primary shock absorber is nearly gone. The U.S. Strategic Petroleum Reserve is currently sitting at just 300 million barrels. To put that into perspective, that is less than half of its total capacity and literally the lowest level we have seen since 1983. If global oil supply gets choked off any further, the U.S. has very limited capability to artificially suppress prices at the pump. Meanwhile, deep inside the private credit markets, a totally different trap has been springing. With interest rates this high, cash-strapped companies have been using a relief valve called PIKE, payment in kind. Basically, they defer their cash interest payments, but that interest gets added directly to the principal. So while the loan appears completely up to date on paper, the total debt is ballooning entirely out of control. Take the Medallia case study, for instance. They used PIKE delays for about 4 years. The result? Their debt exploded to $2.8 billion, ultimately ending in a creditor takeover. Private credit firms are suddenly terrified of these defaults.
Let's pivot to Section 3, AI's broadening innovation engine.
Now, what's really interesting about this is With all these tripwires, you might be asking, why in the world hasn't the market collapsed already? It's because the unstoppable AI bull case is pushing back in the exact opposite direction. And the AI story is no longer just about a few big software companies. It is aggressively expanded into massive physical infrastructure. CoreWeave is seeing record revenues in compute, up 15%. Foxconn is boosting server manufacturing, up 2%. And we've got Intel's massive $20 billion sale. Plus, Lumentum just smashed earnings with optical networking revenue up 109% because data centers desperately need high-speed links. And backing the whole shebang up is a massive capital pipeline, like Bank of America injecting $250 billion into data centers and energy infrastructure. The innovation engine is broadening and industrializing in a huge way. And the bleeding edge of this innovation is already pushing past traditional AI straight into quantum computing. Just look at Quantinuum. Their Q2 report showed a massive $555 million operating loss. Now, for a normal company, that's a total death sentence. But they are receiving massive institutional backing, including a $100 million federal funding injection. Why? Because they're integrating quantum hardware natively into Oracle data centers. The market is happily funding these massive losses today just so they can own the hybrid compute architecture of tomorrow.
This brings us to Section 4, Market Distortions and Hedges.
When you have immense systemic risks pulling one way and a relentless technological boom pulling the other, things get weird. For example, despite the booming AI narrative, retail investors are terrified. There is a staggering, mountainous $3 trillion currently parked in money market funds. People are aggressively seeking the safety of cash, but at the exact same time, there's a massive institutional flight to alternative hedges, pushing the price of gold surging past $4,420 an ounce. So you literally have a booming tech market right alongside record hoarding of cash and gold.
And these financial distortions are trickling down into everyday life in some pretty fascinating ways, including the lottery. Because of high bond yields, the theoretical value of the 30-year annuity that funds the Powerball is massive. This allows them to advertise a jaw-dropping $1 billion jackpot. But here's the catch. The upfront cash value for the winner is only $433 million. That's just 43% of the advertised prize. Back in 2021, a smaller $731 million jackpot actually yielded a much higher $547 million cash value. Yield dynamics are literally inflating the billboards you drive past every single day. We're also seeing this macro friction show up as everyday consumer pain and system glitches. For instance, StubHub is facing a federal class action suit over a 1% failure rate that is flat out denying people entry to events. On an international scale, U.S. travelers to Europe are getting caught in massive delays due to the EU's messy rollout of its new biometric border system. As systems become more complex and underfunded due to tightening financial conditions, the hidden costs just get passed down to the consumer as sheer operational friction. All right, Section 5, the wall of capital.
So, what is keeping the stock market levitating through all this friction and geopolitical danger? Well, there are 4 distinct mechanical streams of capital relentlessly flowing into U.S. equities right now. First, as the VIX drops, algorithmic trading strategies and hedge funds are automatically releveraging. Second, passive ETF investors are continuously buying every single week, completely regardless of the news. Third, retail investors who fled during the late June sell-off are slowly creeping back in. But the fourth, and definitely the most important component, is a massive $1 trillion window of authorized corporate share buybacks currently opening up. Corporate America is effectively buying its own stock to support the market, overpowering the bears with sheer financial force. Finally, Section 6, bull versus bear synthesis. We've covered a ton of ground today, from central banks all the way to the Powerball. But when you put it all together side by side, the picture actually becomes really clear. The macro environment is incredibly fragile. The tripwires, the Bank of Japan carry trade unwind, the Strait of Hormuz oil shock, the labor exodus, and those private credit debt traps are all very real and highly dangerous. But in the immediate term, the tailwinds, that massive $1 trillion wall of mechanical buying flows, combined with incredibly robust AI and infrastructure earnings, are actively overpowering those systemic risks. The money is simply too loud right now to let the market fall. But that leads us to the ultimate question you really need to keep in mind as we move through the rest of this quarter. Which of these will break first? The systemic tripwires or the mechanical wall of capital? All it might take is a single policy shift, particularly that upcoming September rate differential between the Bank of Japan and the Federal Reserve, to act as the catalyst for a massive trend reversal. The vice is tight, the surface is calm, and something eventually has to give. Thanks so much for joining me on this explainer, and I'll catch you next time as we continue to track exactly where these markets are heading.